Hi, Tim Bigham back on a Tuesday, and for the first time in a while, a big down Tuesday. So, to quote one of my favorite bands, Guns N' Roses, all it takes sometimes is just a little patience. As the loyal viewers here have known, I've been less than enthusiastic about the market over the past several months, and have been, outright wrong to say the least, as the market just seemed to forge ahead. Over the past week and a half or so, finally starting to get rewarded for having that kind of short stance with some long puts and some short out of the money call spreads, using today's price action to take off some of those puts with the jump up in VIX. We got that dual benefit of not only the market heading away, but implied volatility as well heading our way, and still looking to continue to sell out of the money call spreads going forward. I think with the VIX at these levels, it favors short option strategies over long option strategies. So take a bearish stance, although hedged and guarded, by selling about 5 to 7% out of the money call spreads on the major indices, and then on stocks that we talked about last week, like Google, Tesla, some of the high flyers, Green Mountain, Netflix, looking at the old highs they had a couple weeks ago, positioning that short call strike just above there, and then depending on the price of the stock, buying something either 1 or 2 strikes higher. Again, just looking for the market to have trouble going forward. What happened overnight with the Bank of Japan certainly brought forward that free money kind of parade, maybe coming to an end here as well. So given the fact that earnings have come in less than stellar, and actually the pre-announcements have been the worst since 2001 as far as guidance going forward. We've had about 83% of the companies that have guided actually lower. So at some point, valuations do come to the forefront, especially given the fact that we have the 10-year well above 2% and the 30-year well above 3%. So bonds at these levels providing a little competition. Also the fact that buy the dividend-paying stocks because they're yielding more than the 10-year. That game, given the run-up we saw in those yielding stocks, and given the run-up we've seen in the 10-year yield, that sort of comparative attraction on those high yielders has come to an end as well. So I think we're going to have a tough summer going forward here based on earnings, based on the fact that, we're nearer the end than the beginning, certainly on quantitative easing. So, until further notice, I still take a guarded bearish stance here, maybe not buying puts, but in place selling some out of the money call spreads. So until next time, this is Tim Bigham. As always, keep those position sizes accordingly and those stops in place. Take care.